Hi, everybody. It's Ed Yardeni. I'm wearing my Hawaii shirt here and got Hawaii in the background. The reason for that is that I don't wish to be in Hawaii. I'm perfectly happy here in Long Island, where it's almost 80 degrees on May 7th of 2022. So we're having a remarkable warm spell here and enjoying it quite a bit. Not as much as if the ocean was right behind me, but let me go back to reality here. So choose virtual background, and we'll go to the office. So here we are. Okay, thanks for tuning in. I screwed up again on the 11 o'clock. I think I finally figured out what needs to be done. I worked it out with my IT guy, but we'll try to avoid having this problem again next week, but no promises. It's all IT, and IT is great except when it doesn't work. Lots of things to talk about. Don't forget to vote, and don't forget to buy a lottery ticket here. It'll make you a billionaire if you happen to pick the right combination. It hasn't been easy to become a billionaire this year if you're a long-only kind of portfolio manager. If you've been short the market, short bonds, you would have made a killing. But most institutional accounts tend to be long in their portfolios and have a limited amount of ability to deal with the kind of environment we've had. But clearly, it's been a tough year so far. The question is, where do we go from here? And we'll get part of that answer on Thursday when the CPI comes out. I think we're going to see some more signs of moderation, certainly in the goods side, but it's the services side that's going to continue to be sticky, particularly on the rent side. But there have been some other areas, for example, health insurance in the CPI is up like 28% on a year-over-year basis. It's up more like 1.5% in the consumption deflator. So there's some differences, not a lot of differences with CPI and the PCD, but they're enough to make a difference. Rent has a much bigger weight in the CPI than in the PCED. We also know that durable goods inflation tends to be lower in the PCED than in the CPI. Maybe it's because the PCED tries to account for substitution effects. When prices of goods go up, people do tend to substitute, and the PCED is better at capturing that than is the CPI. But meanwhile, before we get to Thursday, we'll see how things unfold tomorrow during Election Day, and the midterm election results could take a while to be fully updated, given the different ways of counting the votes and all that. And but the market seems to be kind of anticipating that there's going to be a red wave, that at least the House will go to the Republicans, and the Senate still seems to be a toss-up. And that's widely viewed as being a bullish development. I guess the idea being that gridlock is better than having one party run the government all by itself without any countervailing force representing the other interests of Americans. And right now, we're extremely partisan. It seems to be 50-50 just about in any issue that one can come up with. But I've been thinking about the gridlock issue. I mean, there is a downside to gridlock, and that is by some accounts, the Republicans intend to really go at the Democratic administration and the Democrats on the other side of the aisle, if in fact they have more power, at least in the House. And there's talk that some of them are willing to shut the government down if the Democrats don't respond to some of their demands. So I think one fellow who's running in Arizona said that if he's elected, he'll have no compulsion about telling the Democrats that if they don't do something about the immigration issue, the illegal immigration issue, then he's not going to vote to raise the debt ceiling. So we could have a lot more partisanship, social tension. I mean, it's not a layup here that just because we might have more gridlock that it's going to be sufficiently bullish for the stock market, especially when you consider that Jay Powell is at his peak hawkishness right now, and has said that he intends to raise interest rates until he sees clear signs that they're bringing inflation down. Now, I think there's a little bit of a conflict that's starting to occur within the Fed. We saw it last Wednesday when the FOMC statement came out, and initially the markets thought, hey, that's pretty bullish, because the statements basically said, you know, we've done a lot of tightening, and there are lags in the impact of tightening, and we have to factor in that it's been cumulative. We've been tightening for a while, and we've been doing it since March, but that's not really that long in terms of its impact on the economy. So that implied that there might be one more rate hike in December, and then maybe they would pause just to let the cumulative tightening work its way through the system with the lags, and then decide whether they have done enough. Now, that language about cumulative tightening and the cumulative effect of monetary tightening and lags, that language happened to be almost identical to language that appeared in Fed Vice Chair Lael Brainard's commentary speech on October 10th. And she, again, gave a very reasonable speech in which she said, we've tightened a lot. It's been cumulative, and there's lags. And she didn't say we should pause, but she certainly said specifically that she felt that the durable goods inflation would continue to moderate. And on the other hand, she acknowledged that services inflation could take a while, but she seemed to be kind of more willing to wait. So hence I wrote this piece this morning called Powell is from Mars, Brainard is from Venus. Powell used to be on Venus in 2020 and 2021. He was very liberal, very focused on bringing the unemployment rate down, didn't get too concerned about the impact on inflation. But this year he's become increasingly hawkish and has basically moved to Mars with his attitude that we've got to raise interest rates a la Volcker, kind of Volcker 2.0. So he's promoting Volcker 2.0. I think Lael Brainard is promoting something more like Volcker 1.5. I'm more sympathetic to Brainard's position, but Powell spoke as though he was speaking for the entire committee. I mean, he was a one-man dot plot band. Usually, Fed chairs don't give us a hint of what the next dot plot might be. But even though it's still a ways, mid-December before the next FOMC meeting, he basically took the position that we, implying the entire committee, has responded to the latest data by concluding that interest rates are going to have to go higher and stay higher for longer in order to bring inflation down. I think that's actually pretty presumptuous, because let's see what the actual dot plot says. But I think it's pretty clear that it's going to show a higher Fed funds rate and a higher inflation rate in terms of the near term. But the policy implications, I think, are still debatable. As a matter of fact, as we know, the market kind of got excited Friday before the latest blackout period. So I guess about a week ago, got excited that there was an article in the Wall Street Journal saying that some FOMC officials were starting to talk about stepping down in terms of the tightening and maybe slowing it up a bit. And before that, a week before that, maybe 2 weeks before that, we had Jim Bullard, the Fed St. Louis chief, say that he favored 75 in November, 75 in December, and then pausing. And he's usually been pretty good at anticipating what his colleagues eventually wind up doing. So that's where we are. I mean, the inflation news will probably be more once the midterm election data is out, maybe we'll have a rally on some red wave, but the CPI will be probably the most important indicator. Let's go to the charts here and see what we can see that either supports or doesn't support this tail. This is the website. Just wanted to bring to your attention that you can go to the top here and get exclusive free downloads of all my books in PDF in case you want to have something to read during the holidays. Then over here, over the past few months, we've introduced QuickTakes. I hope you like them. We've gotten good feedback on it. And so you can go here for the archive. As you can see, it's maybe not. Well, you press on that on your machine, it'll open for sure. There it is. Okay, so you can see the archive of the QuickTakes. And then the webcasts are always posted here, so you can always catch up on the webcasts if you missed any. So now, without any further ado, let's go to, maybe I got too many things going on here. Let's go to morning briefing, and let's look at the bullet points. So here's the executive summary, and here's the Powell is from Mars, Brainerd is from Venus. So let's look at the chart collection. So what's the market been doing? Well, we all know, we watch it all together. So it's a very unusual brotherly and sisterly business we're in. We're all kind of go through the same experiences. I mean, engineers, accountants, lawyers, they don't share all these experiences the way we do on a daily basis. So we've all experienced all of this. As you can see on the chart, the S&P 500, we jumped through the 50-day moving average a few days ago. Now we're right back down below it, trying to figure out what's next. I still think that this level of the 3666, which was the low in June, we breached it here, but then we are back up again. I'm thinking it's going to hold, and that's under my most likely scenario. My base case is a 60% probability of a soft landing. So I think I'm being reasonable in pointing out that things may not go all that well. It's sad that 60% soft landing is things going well, but there is a 40% chance of a hard landing. So it's only two scenarios. I don't see any chance of an inflationary boom or disinflationary boom or anything really happening here anytime soon. But in this scenario, this level holds. The forward PE holds around 15. Forward earnings go sideways around 235. In the hard landing scenario, we go down to at least 200 on the earnings. And if by some magic 15 holds, that would still be 3,000 on the S&P 500. So there clearly is a lot more downside in a hard landing scenario, whereas in my scenario, we kind of muddle through this whole unpleasant situation we've been in. This is the same story. If in fact we made a low on October 12th in the bear market, then it would have lasted 282 days and been down 25%. The historical record is for something like 330 days on average for bear markets, and something like 36% for the, or 33% for the downside. So just to put that into some perspective, this is what I think has the market somewhat inclined to be moved to the upside, to be bullish rather than bearish, is, as I've shown you before, if you look at the record of midterm elections. So it's the S&P 500. The green lines are when the midterm elections occurred and through 1 year. And the same thing here, had to have two charts to be able to show all this data. And if we go back to 1942 right here, that's 20 midterm election cycles, and 20 times 3 is 60. Why 3? Well, there's 3 months, 6 months, and 12 months. And of those 60 periods, only 3 of them were actually down. So there's a really pretty persistent bullish trend following midterm elections. Doesn't have to happen every time, and there have been exceptions, very few exceptions, and this could be an exception because Jerome Powell is hawkish and will continue to be hawkish and convince other members of the FOMC to be hawkish. This, by the way, is kind of irrespective of what the lineup is, what the makeup is of Congress relative to the White House. We did more work on that in this piece, and it's not very compelling one way or the other. Bottom line is the market has long history of doing quite well following midterms. The actual makeup of the White House versus the Senate and the House doesn't seem to make all that much difference. It certainly doesn't make much difference when we look at federal debt, no matter who's in the White House, who's in Congress, whether it's a unified government or a divided government. Politicians seem to have one thing in common, and that is if you can't agree on your spending versus my spending, why don't we agree on both of our spendings and just deficit finance it and issue more debt? The problem with that, of course, is you can do it until you can't do it. As you can see, this is U.S. federal government outlays versus net interest paid. I get a lot of people asking me this question about when are we going to hit a brick wall here? At what point have we issued so much debt that the markets or some force of nature or divine nature or some divinity says no more, no mas, you can't do this anymore? Well, maybe we're about to find out, because we have been increasing the debt dramatically. And even as interest rates fell during this period, you can see that interest expense of the government went up, and now it's absolutely soaring. One way to monitor this, other than looking at that series, is to put that series on top of, let's call it Blue Angels analysis for the net interest paid by the federal government. So this shows you what the federal debt costs us at 1%, 2%, 3%, 4%, 5% interest rates. And right now it's costing, as we just saw here, something like almost it's approaching $500 billion. Now at 3%, you get up to, I guess, about $700 billion. At 4%, you're starting to approach $1 trillion, or you are at $1 trillion. So this is worrisome. Right now we're at 2%, and clearly we're, given where interest rates are, a lot of the federal debt is going to start to get rolled over into 3% and 4%, and so we are looking at those kind of numbers. The offset is people are still buying these bonds. As I've said before, foreigners have been big buyers of these bonds. Somebody just gave me a really long question here, so I'll leave some time for it. But yeah, go ahead and throw some questions at me, and I'll take them as soon as I'm done with this monologue. Here's the federal outlays and receipts. So one of the offsets to this increase in government spending on net interest is receipts. Receipts have soared by about $1 trillion, and some of that is because of inflation. So inflation has pushed interest rates up, but it's also, and therefore net interest cost, but inflation has also pushed up revenues. And again, I'm not telling you that these are sustainable situations, and they're certainly not pretty pictures, but that's what we'll be watching here to see how this all plays out. The doom and gloomers are saying that it's going to play out, obviously, with a doom and gloom scenario. I guess you'll take me there kicking and screaming, but I'm aware of the doom and gloom scenario, and I'm monitoring it. And by the way, the doom and gloomers do a great job of telling us how everything's going to fall apart. I don't happen to think the world's going to come unglued, but they're making that point. Obviously, a lot in the near term here will depend on inflation. It's certainly going to feel pretty unglued if we get inflation surprises to the upside as opposed to the downside. There's some potential happy news here. We've seen tomorrow we're going to get an update of this data, so I'll be watching that. I'll probably put a QuickTakes out on it if I have time in between my day job of putting out a morning briefing. But as you can see, the average selling prices has come down. Planning to raise prices is down, and raising prices is down, but it's still very elevated. So it's not as though, we're suddenly going to see all these small businesses saying that they're not going to increase prices. I'm somewhat encouraged by this as a leading indicator. This is the ISM prices paid index in manufacturing. I had to push it 3 months ahead to make it a useful leading indicator. And this is versus the CPI goods inflation rate. So it's non-durables and durables. And as you can see, this really suggests that this peaking in the CPI goods is for real. It's being confirmed by the ISM prices paid index, and it's suggesting that we could have this goods inflation rate coming down to zero early next year. Zero is something that we used to do pretty readily prior to this inflation surge. Obviously, you're seeing durable goods inflation turn negative, which it could, especially now that we're seeing used car prices down 10%, and appliance prices are falling, furniture prices are rising at a slower pace. It's new cars that are still a problem, but this is conceivable. This is the gasoline pump price. That's one of the goods in the CPI goods and PCED. And that's had a little uptick in October, so it's not going to give us much inflation relief. But on the other hand, it's not going to be a big source of inflation problems in the October data that comes out on Thursday. This is where the problems lie. It's in the services, and this is CPI services yearly percent change, and no signs of a peak yet. And a lot of that is because there's no signs of a rent peak, but some of the other components like veterinary charge, what it costs to take your dog and cat or parrot to a vet, that's gone up a lot. As I mentioned before, the insurance for healthcare has gone up a lot. But this gives us some hope that we're getting close to a peak. And then once that happens, it's going to take longer than the good side. But by the middle of next year, we should be seeing some moderation in the services inflation rate. So there is obviously stickiness in that rate. Average hourly earnings came out with the payroll employment data on Friday, and there's some hint that things are peaking and slowing down. Not enough to dissuade Powell from remaining hawkish. We are seeing that the yearly percent change is 4.4 for goods producing and 4.1 for the 3 month. So there's some indication that things are moderating, though you can barely see it in this chart. A little bit more moderation service providing. Here's the 1 year 4.8, and this is the 3 point. This is wages now. Hope I'm not getting you kind of confused here between prices and wages, but wages do matter. Well, let's open it up for a little discussion here. Some of you who tuned in late might be wondering why I'm wearing this Hawaii shirt, and the answer is it's almost 80 degrees here in Long Island. I hope it's nice where you are. Okay, Anurag, there appears to be a trifecta of inflationary concerns: supply side, food, oil, Ukraine, China; demand side, wages, labor, participation rate, and monetary excesses of most developed central banks. What is your opinion on whether this will result in a lack of confidence in fiat currencies, I guess, manifested in higher real interest rates in the intermediate time frame? Any precedents of? It's a long question, and it's probably requires a really long answer. So I'll do more work on it, thinking about it, write about it. But the point you're making is there are a lot of inflationary pressures out there still. But then again, I think we're also seeing that inflationary pressures in goods are moderating, and some of the CPI components on the services side don't have as much of an impact on the PCED. But look, we have the PCD coming down to 3 to 4%. Right now, it's still around 6%, but 3 to 4% is our goal for next year, and we think it's doable. Samir, the 3 month annualized CPI is 2.02%. If that is a reliable harbinger for future CPI prints, yeah, the 3 month headline is done really well, and that's to a large extent because energy has come down. Gasoline prices have come down. We know gasoline prices uptick in October. We know the natural gas probably, I think it's still a slight downtick in October. Diesel fuel, on the other hand, has gone up a lot now. Very few of us have drive diesel cars with diesel engines, but truckers need diesel, and if that costs them more, that might get passed on into prices. So that's something to be concerned about. But we do look at the year-over-year percent change compared to the 3-month to get some sense of whether the short-term inflationary pressures are down or up. And the 3-month work we're doing suggests that they're mostly down across quite a few items, not just gasoline. William, since the mega cap route came late in the year, do you think tax loss selling will dominate the rest of the year? Gundlach is making this point according to CNBC. I think everything that's being sold is being sold for tax loss selling purposes at this point, probably creating some pretty good opportunities for those of you who have cash or at some point are looking to take the cash you're raising when you're taking your tax losses. And that I think there must be a lot of that going on because the bond market's down like 33%. The stock market at its worst was down 25%. I think now it's about down 20%. So there's probably lots of that going on. Let's see, Samir, I'm not quite sure. You asked another question, but I don't see the text. So let me move on to Anonymous. You recently published a piece about the potential paths of the S&P 500 under various earnings and PE scenarios. Your basic thesis was that corporate earnings, ex energy and healthcare, were disappointing, and that the forward language was negative. The forward language is negative. Meanwhile, PEs are likely to compress given the higher rate environment. How do you reconcile this relatively bearish forecast with some of the charts you've shared today? See the midterm election bump. Well, there's always lots of charts to support both the bearish and bullish positions. In addition, a position isn't necessarily one that I or you hold with 100% certainty. We're always giving subjective probabilities to these things. And in my case, I'm giving a subjective probability of 60% to a rolling recession. I'm just trying to see if I got more questions here. The arrow doesn't want to go down. Let me try this. So there's always those subjective probabilities, and my subjective probability is 60% for a rolling recession, growth recession, mid-cycle slowdown. I think we're already in a recession in some sectors, and I think they'll get worse through the middle of the year, and by the time other sectors start to get worse, I think they'll be better. So it kind of rolls around. But I think by the second half of the year, we'll actually be looking at better growth and won't be worried about a recession. So that 40% is the hard landing. The hard landing scenarios where earnings would be lower clearly, and because revenues, profit margins, and earnings would all be lower. Somebody just asked me by email to look into, can we have a profits recession without having an economic recession? And I think the answer is probably going to be yes, but we know for sure that economic recessions depress earnings. You get earnings recessions during economic recessions for sure, because revenues go down, margins go down, and earnings go down. And then I would say at a 15 multiple, we're not. We have no reason to believe that we're safe from lower valuation multiples if, in fact, we get a hard landing recession. Soft landing recession, I think, will probably hold on to this the current multiple. Okay, let me see what we got here. Oh, we got. Why isn't unemployment rising already? I'm doing some, I'm glad you asked that question. I'm doing some work on the unemployment rate on the labor market for tomorrow's morning briefing. So some of you will get it this afternoon for the advanced copy. I think you're all getting it unless you don't want it. Ever since the pandemic, everything's been kind of topsy-turvy. And I think that includes the labor market. And, we're clearly seeing baby boomers retiring. we're seeing that the new entrants to the labor market are young. They're not particularly, they have no real experience. They're not really all that productive. So that's having an impact on productivity. And there just seems to be, I mean, it's just anecdotal. I don't have any hard data. I can't show you this in a chart, but from family and friends and so on, I get the impression that there's quite a big difference between the attitude towards work and a job by the baby boomers and the younger folks. Baby boomers had this idea that once they came out of college, they'd work for the same company the rest of their lives, and they'd be kind of promoted to AVP and then a VP, then SVP and EP. And, you know, if you mention these terms to young workers, some of them will probably say, well, is that a name of a new cryptocurrency? But no, it was the idea that you'd rise in the ladder from, a new employee to assistant vice president, and so on. I don't think younger workers have that sort of mentality. I don't think they have the kind of loyalty or expect to be working for any company all that long. So they tend to quit, I think, more quickly, especially than baby boomers who already have staked out most of their career in whatever company they've been with. And it may not be the same company, but it may be a company they've been with for the past 5-10 years. And so at this point, there's no point in quitting for getting a higher wage. I got too much vested here and so on. But the younger folks are footloose and fancy free and more inclined to quit. And they have an incentive. I mean, there's an economic incentive to quit jobs if you can get a better pay and better working conditions. And so there's a lot of that going on here that's created this very funky labor market. And so we've got a shortage of labor. I think companies, as a result, are hoarding labor. They're not as willing to get rid of labor and want to have more workers than they actually need. And this is all depressing productivity. But I think along the way here, and maybe not that long down the road, companies are going to conclude that this is no way to run a business. And I think you're going to see that they actually invest a lot more in technology, capital goods to increase the productivity of their operations, to be less reliant on workers or to be reliant on workers that have been with you for a while and that you're willing to compensate more because you're educating them more, giving them more tools to be productive. So I appreciate that last question because it does reflect what's on my mind and what I'm writing about. So thanks for joining today. Apologize for the screw up this morning. I can't guarantee, but I hope I don't do it again next week. And I wish you a great week.